Good morning everyone and welcome back to Morning Markets here at True Potential. It's Tuesday the 9th of January and today we'll focus in on two announcements yesterday which are interesting for global growth. One is the announcement from Saudi Arabia regarding their selling prices for global oil, and another was the updated data on the German trade balance. So we've spoken to you a lot about the implied path of inflation over the next few months, and that inflation is likely to fall substantially in global markets. So it's understandable then that most markets will likely focus on growth more this year. One such growth outcome which points to subdued global demand was the announcement from Saudi Arabia yesterday that they are cutting the official selling price of their crude into Asian markets. The cut was around about $2 per barrel, which is the largest price reduction in many years. And it's also taken the price back to where it was about 13 months ago. This points to subdued global demand, and this is despite all of the implied forecasts for increasing global oil demand growth. Where the mistakes are probably being made in the forecast for oil demand is that these forecasters are likely failing to take into account the post-COVID world, less commuting, more working from home, and initiatives such as green revolutions and decarbonisation are all placing lower weight on future oil demand growth. So that was one interesting demand indicator from Asia. Another is in Germany. Yesterday, Germany updated their trade figures through the end of the year, and the trade balance there very much remains in surplus. This really means that private corporations in Germany are generating more in revenue than they are spending. This gives a capital account surplus. This is very healthy from an excess savings point in Germany, but the trend is now back to pre-COVID. That is, the German economy is likely generating excess savings of over 200 billion euros a year. Without any domestic investment opportunities to redeploy this capital, it likely implies that the German economy is going to remain on a very low growth trajectory for this year. That's one particular problem because Germany is already in a technical recession. It's already put through a new budget for this year, which is likely to see reduced spending. And also we're going to see future forecasts for growth revised down. So Germany is likely to remain in a growth recession for this year. Surprisingly though, we're not seeing it proliferate into the wider economy, such as into rising unemployment. However, this likely means that the Eurozone as a whole is going to see lower growth this year, given Germany is the largest economy there. That may compound the disinflation narrative that Germany and the wider Eurozone are exhibiting. We're likely to see substantial falls in inflation in the Eurozone, and with interest rates at a multi-decade high, it may place further pressure on the ECB to update their forecasts and their communication as we go into the spring. So, two growth indicators there, one from Europe, one from Asia, which point to subdued global demand. That's all for today, but please join us tomorrow where we'll update you again on global markets. Thank you.